Hello and welcome to our special Budget 2025 series, where we bring you expert insights from industry leaders on what to expect from the upcoming union budget and how it may impact investments. Now, today we have with us Mahendra Kumar Jajoo. He's CIO of Fixed Income at Mirae Asset Investment Managers. Mr. Jajoo, thank you for joining us today.
Thank you for inviting me.
Now, how do you see the RBI's interest rate trajectory shaping the debt market?
Well, if we look at the current situation, we expect the interest rates to soften from here. Over the last 18 months, the Reserve Bank has remained on pause. In the last 6 months, we have seen the global interest rate cycle beginning to get more accommodative. The Federal Reserve of US has already cut rates a couple of times already in the last 6 months. Globally, the inflation has come down. And therefore, it's an expectation that in due course, we will see rate cuts happening in India also. One of the difficulties that we have faced in India is of highly volatile and generally towards the higher range of inflation. The range for the inflation has remained in about 3.5 to close to 7%. But most of the volatility in the inflation has been driven by the highly volatile food and vegetable prices, as I said. And now we are seeing the global inflation come down, global central banks cutting rates. We are now seeing somewhat stability in the geopolitical situation. We know that the Lebanon or the Israel situation is beginning to stabilize. And therefore, expectation is that in due course, the rates will come down. Now, when we talk about RBI getting more accommodative, it does not necessarily mean policy rate cuts. But for example, we have been struggling with a very tight liquidity situation over the last year or so. In the last quarter, the liquidity tightness has become more acute. And we have already seen RBI cut the CRR by 50 basis points in the last policy. With expectation of inflation beginning to settle down again, there is hope emerging that RBI will become more accommodative. We have already seen RBI buying bonds after a long gap in the last week. Today, the 10-year yield is trading at 6.66% or so, which is the lowest that we have seen in the last 1 year. So I think the market sentiment is becoming more constructive. The macro environment is becoming more constructive. There is a justification for the interest rates to soften. One of the biggest challenge that again we have is of a growth slowdown. Last quarter, the growth was reported at 5.4%. There is a lot of optimism right now that somehow the growth will come back to a fast track quickly. But in my view, it is going to be a very challenging job to bring the growth back to a strong momentum. At this point, we might have to just keep running on the treadmill to maintain the pace of growth. And one of the most important statement from the Reserve Bank last year, which we heard multiple times, was that as long as the growth is strong, it gives them a longer space to align interest rate with their long-term objective of 4%. With growth slowing down, with inflation beginning to stabilize, with the global central banks cutting rates, I would think that there is a space for the interest rates to ease and for RBI to turn more accommodative. And therefore, we are very constructive on the fixed income for the year 2025.
All right. You did mention that you expect inflation to settle down. How do you see it impacting debt fund returns here on?
So, if the inflation comes down, obviously it is positive for the fixed income markets. Now, inflation has been very volatile in India, as I mentioned earlier, over the last 1.5 years. But if you look at the factors which are driving the inflation, there is no immediate threat that inflation can escalate to non-acceptable levels. First of all, the core inflation has been very, very low it has been below 4% for almost 6 months now, which is the target of the Reserve Bank. The headline inflation has been very volatile, and right now it is at about 5.5% for the last 6 months. In between, it had gone up to 6.5%, then it quickly came down. So the volatility of the food and vegetable prices is something that has to be addressed. Now, there is no magic that will happen that the food prices will suddenly become less volatile, because that is the nature of those markets. So what will then lead to the policymakers focusing more on the core inflation, or make them for the time being look through the volatile inflation? We have seen the same thing happen in the last year. We have seen the same thing happen in the year before that. So within the overall policy framework and the policy stance, the central banks will have to consider whether this volatility is going to be generalized or not. I think that is the core criteria. So what are the recent developments? One is that the geopolitical instability, which was one of the biggest concern for the central banks, is beginning to stabilize after Mr. Trump has assumed office. And in the prelude to that, we have already seen number of geopolitical flashpoints begin to stabilize. Now, it is too early to say whether that is a sustainable situation, but at this point, we are expecting more positive developments on the Russia-Ukraine front, for example. And then the commodity prices post the pandemic recovery, post the stability of the geopolitical situation, have been trending down. For example, in spite of very significant geopolitical instability, oil prices have come down on year-to-year basis for last 2 years. So oil prices on year-to-year comparative basis from between 23 to 24 are lower. So there is no immediate threat of inflation getting escalated to a non-acceptable level. And therefore, I think that is one front where, while the central banks will be watchful, I think there is room to be a little more constructive. So inflation at this point in time, in my view, is going to support lowering of the rates. We have another big factor which every year causes us a lot of uncertainty. That is, our dependence on the monsoon is still too high. So if the monsoon is good, then we have floods. If the monsoon is deficit, then we have drought. Then we have to look at the distribution of the monsoon, both in terms of the time. So whether you have surplus rains at the time of sowing, or you have a back-ended monsoon. So all these factors, while they settle down on a eventual basis, they continue to pose uncertainty on an ongoing basis. So that's something, again, we have to see how it settles down this year. And this year, people are saying that because of El Nino or El Nina, there could be other factors. But my personal view is that the unpredictability of the monsoon or etc. has largely been addressed by the proactive government policy in terms of the distribution efficiency, or storing efficiency, or price control. So therefore, I think there is every reason to feel a little more confident about the inflation not becoming a big factor in terms of the interest rate policy.
Sir, so given the current inflation and the interest rates which you mentioned, what is the strategy for the duration funds?
So, to the extent that we are expecting interest rates to remain here or move somewhat lower, obviously we would want to be fully invested right now. In most of our duration fund, we would want to be as fully invested. Now, while we say that, we have to also remember that the RBI has been on hold for close to 18 months now. The expectations for the rate cuts by the US Central Bank have been live for the past 6 months, and most of the market is now expecting the Reserve Bank to cut rates sometimes in February policy, or maybe then in April policy. Before that, if you look back in November, people were beginning to expect the Reserve Bank to cut rates even in December, when the Fed cut rates in its policy. So what is important to recognize is that a lot of the positivity is already factored in by the market. So just to recount the numbers, the 10-year yield in in India has already come down to close to 6.7% from a high of 7.6% last year. So there is a 90 basis point easing has taken place in anticipation of the rate cuts coming. Then most of the market is expecting the Reserve Bank to have a shallow rate cut cycle, because when the US was hiking rates, RBI stopped much earlier before the US peaked, and therefore obviously there is lesser room for the Reserve Bank to cut rates, especially given the fact that headline inflation is still above 5%. So therefore, if you take a terminal rate of, let's say, 6% for the RBI after the rate cuts happened, then the 10-year at about 665, 670 looks fairly valued, given by the valuation norms that we follow, or the historical patterns, etc. So there is very, thin margin which is left right now based on the current assessment. Then one has to analyze whether or not there are possibilities of RBI going deeper into the rate cut cycle, which will obviously depend on how the things evolve. The other factor which has become very important is that while the Federal Reserve is cutting rates, the long-term rates in US have gone up. So the US curve has become very steep, and in the previous months, that was causing a lot of discussion on how that should be dealt with. I think it is becoming increasingly clear that the steepness in the US yield curve is a local factor. So US has its own challenges in terms of fiscal deficit, or inflation because of the Trump policies, or otherwise. And another important factor is the demand for the US bonds has come down significantly, because Russia and China are no longer buying the US bonds. The last 1 year, the gold prices have gone to an all-time high. One of the reasons driving the gold price also is the global central banks de-dollarizing their reserves. So there is a certain, effort by every central bank to diversify their reserves away from the dollars. And that has led to poorer demand of the US bonds, which can again explain the long-term US yields going up. I think those factors are now becoming clearer to the market, and therefore market is worrying less about the long-term US yields going up and focusing more on the domestic factors. When that situation can change, because eventually India needs to have capital from the overseas investors to balance the current account deficit. And right now what we are seeing is the continuous outflow from the FBIs. And now even the FDI is also negative. And because the Indians are investing more abroad than the foreigners investing in India. So these are some of the factors that have to be kept in mind while deploying your assets in the duration funds. So the point I'm trying to make is that at this point we are fully invested, but we are fully aware of the risk factors, and therefore the policy will be calibrated depending on how the things evolve. We have to also remember that we have two big events coming up in the next few days. We have the budget announcement, and then we have the next review of the RBI's monetary policy. Budget can lead to big changes in the expectations. For example, as to what the fiscal deficit will be, or whether there is any relief for personal income taxes or not. And then we have the first policy review with the new governor. And after, Mr. Trump assuming office. So there could be significant changes in the assessment on the geopolitical situation and in terms of the inflation trajectory. So we have to watch it carefully. Uh, we are completely aligned to what might happen, and therefore, as and when the market expectations change or new information is available, we'll be willing to recalibrate our positions accordingly. But again, even after factoring in all this, in upcoming events, I would like to be on the positive side at this point, and I would like to believe that there is still some juice left in the market for the fixed income investors.
Okay, and so like you mentioned, the global factors like US rate cuts and easing geopolitical uncertainties, how are they impacting the Indian debt markets?
So I think there are clearly two phases in the last few months. One is pre Mr. Trump assuming office and post. So pre, there were a lot of apprehensions in the market that because of the tariff hikes or because of the tax cuts, the fiscal deficit will balloon in US or that inflation will spike in US. So there were a lot of different you know scenarios which the market had built. If you look at our assessment of what might have happened in November and in December, we were very clear on two things: that alongside the tariff hike and the tax cut, Mr. Trump also talked about stopping the war, and then he was focusing on rationalizing the government expenditure. And we are already seeing that the geopolitical situation is improving at a rapid pace, with the Israel situation beginning to stabilize and expecting the Ukraine situation to also improve. And the Department of Government Efficiency is headed by Mr. Elon Musk. Uh, there is obviously a very easy bargain to be had there, because we know all governments are, so to say, uh, leaving enough room for efficiency. Now, the US has stopped all foreign ads with immediate effect, which means that they can save 300 to 500 billion dollars as it is, because there is a lot of ad which goes out. So far, there has been no tariff hike. So far, there has been no tax cut. Now, it is increasingly becoming clear that the tax cut will be offered to new manufacturing facilities set up in US, which is kind of a PLI that we have in India. So I think there is a clear situation where the market had upfronted the Trump trade, and market had completely gone very, very pessimistic on that. So in that sense, now the clarity is emerging, and that we are able to see in the markets, right? So clearly, the geopolitical situation has become more stable. Oil prices have remained low. There is no spurt in commodity prices. Increasingly, it is also clear that the tariff hikes are more of a bargaining tool than the end objective, and therefore, the negativity which had come on account of that will gradually be unwound in the fixed income markets. Then for India, that opens up possibilities for the Reserve Bank to get more accommodative. We are already seeing the RBI beginning to address the liquidity situation, specifically the durable liquidity situation, by beginning to buy bonds in the secondary market. We have the policy review coming up. We will know more as to what the RBI's thought is. I said in the beginning also that when we look at a positive fixed income market, the rate cuts by themselves are not an end, because we have seen in the US that in spite of Fed cutting rate, the long term rates have gone up. So there are two different segments: long term rates and short term rates. Short term rates react to liquidity and immediate RBI policy. Long term rates react to the market expectation of the macro environment. For India, the macro is very positive. The one additional challenge that the RBI has to now deal with, over and above other things, is the growth. And again, I mentioned earlier how the strong growth was giving the RBI the extra space for inflation management. So now with growth slipping lower, clearly the RBI's focus will possibly shift a little bit towards growth more than it was in the previous quarter. So given that, I think both the global environment and the domestic environment is likely to be more constructive and supportive for the fixed income. We have to watch for the budget, what happens in the budget on the fiscal deficit front. But every analyst report that I have read is talking about a fiscal deficit projection for FY25 at lower than 4.9, which was the budget estimate. Everyone is talking of government bringing the fiscal deficit down to 4.5%, which is the stated target of the government for FY26. At this time, when the capex is slowing down already, when the economy is already slowing down, a fiscal consolidation will obviously need to a further slowdown in the economy. That therefore will be again supportive of the fixed income. So while budget is still unknown objective for me right now, and it is very difficult to take a decisive view few days ahead of the budget, because we don't know what is there in the planner's mind. But indications are that it will be further supportive of the fixed income if the projected fiscal consolidation is carried out. And so far this government has been very sensitive to the fiscal consolidation. So I would expect the budget and the monetary policy both to be supportive for the bonds, and therefore positive for fixed income in terms of whatever is happening both in the global and domestic space right now.
Sir, in this situation, what would you advise to the conservative debt investors who are looking to invest in the debt funds?
Yeah, I think that should be obvious by the flow of the discussions so far. So, it's very important, very interesting that it is after a long gap that the bond funds have given a double-digit return in 2024. But most of the people have missed it because of the skepticism, because of the apprehension, because of the indecisiveness, because of the lack of confidence. And to be fair to everyone, the markets have been extremely volatile. So we have seen, just to give you one example, the probability of a Fed rate cut by the market in April 24 was 100%. And then in May it became 0%. And then by September, August, it was again 100%. So markets have been extremely volatile, and that gave a lot of challenge in terms of being able to predict what will happen. But the fact remains that RBI did not cut rates at all in 2024. Fed cut rates towards the last half of 2024. Liquidity has been tight, but the bond funds have given 10% plus return in 24. Now, in 25, whether the bonds can repeat a 10% plus performance, we don't know. But I think we have to say that everyone who wants to look at fixed income has to rise above the skepticism, has to rise above the apprehension, and look for what it is. At this point, there is expectation that rates will moderate further. Obviously, things can change. So whether the investor is conservative or aggressive, and how he should invest is something that his wealth advisor or his advisors can suggest. But in general, if I look at the situation right now, what we are discussing is possibility of some further lowering of the rates. And we have also discussed that a fair part of that rate expectation and its impact has been discounted by the market. Therefore, one has to be careful while investing at the long end. But if therefore one is going at the long end, one should go at the longest end of the duration spectrum to maximize the benefit. And in that context, I would say that one should look at the long duration funds. Now, if you come to the other side, what we have seen is a very tight liquidity environment for better part of the second half of 24. the money market rates have been high. The money market curve has been very steep. So that means 3 month to 12 month, 1 month to 3 month, the slope is very high. The rates are very high. The corporate bond spreads have been very high because of the tight liquidity and good demand from the corporates in the first half. Banks are, still fighting for deposits and CDs. Therefore, for example, right now the spread between bank CD and 3 month T-bill is close to 65-70 basis points. So once RBI starts addressing the liquidity concern, that those spreads will narrow. So there are two opportunities in my assessment in the market right now, which are superior or which are better than the most others. One is go to the longest end if you are an aggressive investor, or if you are expecting rates to come down, and then look at the, say, 1 to 3 year corporate bond segment where the yield curve is inverted and the corporate bond spreads are good. And then how do you allocate the portfolio as possibly a standard figure of 75% at the low duration or short duration category and 25% at the long end. Now this is a very general construct, obviously, for every investor, and I'm not a wealth advisor or a portfolio advisor. I'm a fund manager, but from a general perspective. But individual investor has to obviously look at his own risk profile and consult his wealth advisor.
Before wrapping up this chat, the last one, are there specific sector or the rating you're cautious about in the current credit environment?
So right now, obvious focus is on the MFI segment. I mean, we have had multiple NBFCs declaring result in that segment, and the carnage in that segment is so obvious. Uh, we have been avoiding the MFI segment for some time now, and uh, given the credit collapse that has happened in the last 6 months, given the GDP slowdown that has happened, given the expense capex slowdown that has happened, this has led to maybe this situation. Uh, so that is one segment one has to be very careful. And then once the MFI segment is dealt with, I think in due course it might have a spillover effect into the personal loan segment, into the SME segment. And now we are seeing some sort of volatility in the equities market. So therefore, it can also have impact on the consumer loans in due course. So I think the MFI and that the tier 2, tier 3 NBFCs are something one has to be very careful. The story is now very well known. In my view, most of these NBFCs are well capitalized. They have a good ALM framework and they have a good liquidity. Therefore, I don't expect any of them to default or anything. But I think a lot of people will have to realign their maybe business model or something. So it's a very interesting space, because while there is a challenging situation right now, once the dust settles down and we know who has dealt with this situation in what manner, and then what is the residual strength that they have, it could also offer opportunities to build a fresh portfolio then. So I think that's a segment that we are watching very, very carefully.
Right. Well, that was a very insightful discussion, Mr. Jajoo. Thank you for sharing your thoughts on the broader market outlook.
Thank you once again for inviting me.
To our viewers, stay tuned as we continue to bring you expert opinions and analysis in the run-up to Union Budget. Don't forget to check out our explainer videos and interviews with other industry leaders for a deeper understanding of how the budget might impact your investments. Thanks for watching. We'll see you in the next episode.